Investing in real estate can be a money-making gem. It gives you cash flow, shields against inflation, and spices up your investment mix. But hey, buying actual properties isn't everyone's cup of tea. It's costly, complex, and risky. That's where REITs come to the rescue. Think of them as real estate stocks that own various types of properties. We're diving into the world of REIT, real estate investment trusts, that dish out monthly dividends for some sweet passive income. But before we jump in, do us a favor and hit that like button and subscribe to our channel for more useful updates. Now, the cool thing about REITs is that they must cough up at least 90% of their taxable income in dividends. This makes them a favorite among income-hungry investors. Regular dividends are nice, but how about getting that sweet payout every month? Here's the deal. Consider putting some extra cash into a basket of monthly dividend-paying REITs. With REIT prices having taken a dip lately and dividend yields looking pretty darn good, it's a smart time to snag some high-paying monthly income sources. For a solid REIT basket, think about mixing up the sectors, aiming for a decent dividend yield, and carefully selecting the right REITs that can cover their dividends. This helps you avoid those unpleasant dividend cuts. You can either invest the same amount in each of these REITs or distribute your money evenly among them. So, without further ado, let's check out our top 10 list of REITs that'll shower you with monthly dividends. These companies bring you steady income and a promising shot at long-term growth.
Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys.
First up, we've got Motive Incorporated. They're all about properties. 56 of them, to be exact. These spots are leased to big names like Dollar General, Costco, and 3M. Their properties are spread across 16 states, and they're always full, with a 100% occupancy rate. They just shared their first quarter results, showing they're making more money than before. An analyst gave them a thumbs up and a price target. Although their stock price jumped and then chilled a bit, they're still in the game. Next, meet Chatham Lodging Trust. These guys are into luxury hotels, around 40 of them. They're all over the US, rocking brands like Hilton Garden Inn and Hyatt Place. What's interesting is that they don't just own these hotels. They jazz them up, making them cooler and more valuable. They've got a keen eye for grabbing properties with potential and giving them a facelift. It's like a win-win for both the hotels and the investors. Kicking off at number 8 is Agree Realty Corporation. They're all about retail properties and their dividend game is strong. They pay around 23 cents per share every month, which can add up nicely. Their focus is on properties that house essential retailers like grocery stores and drugstores. These places are less likely to be affected by online shopping or economic ups and downs. It's like investing in the basics that everyone needs. Next up is Broadmark Realty Capital Incorporated at number 7. These folks provide short-term loans to real estate investors and developers. They're like the financial support system for property deals. They've been around for about 12 years and have funded a ton of loans worth billions. They're on our list because they offer a solid monthly dividend and are likely to become even more popular as traditional banks tighten their lending standards. And sliding in at number 6 is AGNC Investment Corporation. They invest in mortgages and have a monthly dividend game that's pretty strong. With their focus on federally guaranteed loans, their risk is relatively low. Their investments are backed by the big guns like Fannie Mae and Freddie Mac. This means they offer a good mix of steady dividends and safety for your investment. At number 5, we've got Realty Income Corporation. They're all about retail properties, and they've got a big portfolio of over 11,400 properties. You're talking about big names like Walgreens, Dollar Tree, and FedEx as tenants. They're known for being reliable, and even when times are tough, they manage to keep making deals. They've been increasing their dividends for a whopping 117 times. That's impressive. Their financials look solid, and they can handle bigger deals than their peers, which sets them up for growth. Number 4 on our list is EPR Properties. These folks are into the experiential game with things like movie theaters, amusement parks, and resorts. They've been affected by the pandemic, like a lot of others, but they're showing resilience. They had to cut their dividend in 2020, but they've since raised it. They're working on bringing in more properties that offer experiences you can't get at home, like movie theaters. Keep in mind, though, if the economy hits a really rough patch or more theaters struggle, there might be some challenges. And coming in at number 3 is LTC Properties Incorporated. These guys are all about healthcare, specifically senior housing and skilled nursing facilities. The pandemic hit this sector pretty hard, but LTC used its strong financials to weather the storm. They've been keeping up their monthly dividend and looking to increase their rental income as things get better. Number 2 is SL Green Realty Corporation. These folks are all about office spaces in the heart of New York City. Despite some challenges due to the pandemic, they've managed to do pretty well. This is because they own some of the best office properties in the city. As more companies look to lease quality office spaces for their employees, SL Green is benefiting. Even though some worry that remote work might stick around, the price of the stock seems to already reflect those concerns. Their financials look good, with their annual funds from operations covering their dividend well. With conditions in the market improving and their business growing, there's potential for the stock price to go up and for them to keep expanding their dividend. And finally, the number 1 spot goes to Stag Industrial Incorporated. These folks are all about industrial and logistics warehouses, and they've been riding the wave of e-commerce growth. About 40% of their properties are directly serving the e-commerce industry, and that's a booming market. Their stock price has taken a bit of a dip recently, making it a good time to consider investing. They're one of the big players in this industrial REIT space, with properties across 41 states. Their earnings have been looking good, and they've got some strong tenants, with Amazon being one of the key players. As the demand for online shopping and fast shipping grows, so does the need for industrial space, which bodes well for Stag Industrial. So, Stag Industrial, which we mentioned earlier, stands out because it offers higher dividends among industrial REITs. They've been raising their dividend consistently for a decade. Their value compared to their performance is looking pretty good. They have a solid outlook with clear long-term growth drivers, especially with their focus on the e-commerce market and their active property acquisitions. This makes them an attractive option for investors looking for passive income. Now, here's a question for you. Out of all these REITs that provide monthly dividends, which ones do you think would be a good addition to your investment portfolio? Let us know your thoughts in the comments below.